Hey guys, Whitney here. Welcome to today's boot camp. We're going to talk about essentially how to not lose money while passive investing. And how I've kind of framed this is essentially like, how do we vet deals and operators? Okay. So this is, if you've been joining our past two series in this boot camp series, we've been talking about how to vet the operator, how to vet the market. So today we're going to concentrate largely on the deal. So we'll do like a little mini recap on how to screen operators, how to screen markets, but we're going to be spending an incredible amount of time on the deal portion. Okay. And I want you to actually do this process alongside of me. Okay. So the difference between the master classes and the boot camps, the master classes are just kind of get you knowing, understanding, different parts of passive investing. The boot camps are meant for you to deep dive in and build the tools that you need that are going to help you apply the knowledge that we've been learning about, but also analyze the deals so you can start investing. Now, one of the things I like to do here on some of the boot camps is bust apart myths. What keeps people on the sideline? And there's actually two myths that keep passive investors sitting on the sideline, never getting into a deal. And one, they think, I have no control. Okay, and that's simply not true. And we've been talking about those various ways that you, as a passive investor, actually have control in a deal. One, you get to decide when you decide to move away from investing in stocks, bonds, and mutual funds and investing into a passive deal, you actually are in full control of your goals. You're in full control of your investing timeline. You're in full control of the risk tolerance that you are choosing to take when you invest. Now, if you're still making that transition from stocks, bonds, and mutual funds into the passive investing world, you might go, yeah, but I can always get out of VTSAX or VTO out of the market. I can sell at any point in time. That's not control. That's just perception. Okay. So this is about you actually making those investment decisions that align with your goals, your risk, and your timeline. And then once you understand that, then you get to invest with the operators that are going to help you achieve your goals. Okay, you get to choose the markets you go into in the business plan that you invest in. And that's what we're going to dive into today. Now, for those of you, if this is your first time joining, welcome. My name is Whitney Elkins-Hutten. I am the Director of Investor Education here at PassiveInvesting.com. And I started real estate investing back in 2002 completely by accident. I bought a house with a significant other. And about a month after that, we bought the house together, the relationships fell apart. And I had a house and I had all the bills associated with it. Not only that, I had all the rehab. And so I bought a book from Home Depot, the Home Depot 1-2-3 book, learned how to do a lot of the things myself. Paid a lot of my friends in beer and sushi and pizza to help me. And that really launched my investing career because I realized I could then unhook how much money I made from how much time I spent. So 11 months later, I made $52,000, just from the sale of the house, and not even counting outsourcing my entire housing bill to my roommates. Anyways, long story short, that just launched me down this path. I now have and then I scaled up to 36, single family properties, doing about 10 fix and flips on the side every year. And then I realized, wow, I just have another job. I'm working full time. I'm trying to, scale this portfolio on the side. And I have now a baby girl at home and I'm taking care of some family members and I wanted to get my time back. And so I'm like, there has to be another way. And so I was like, but maybe I should go into larger real estate deals, have more, get more units with each transaction, have less overhead, be able to outsource everything to expert property management. And then also I stumbled across this whole passive investing where I can invest in somebody else's business that is already running these real estate deals. So like any person, when you can't decide what to do, I decided to do both things at the same time. I'm super happy that I did, launch down both avenues. But I will tell you, the one that has gotten me the best results towards my core value that I want in life, which is financial freedom and freedom of choice, has been the passive investing. And my husband and I have scaled a residential portfolio of over 6,500 units, 2,200 self-storage units. We're now over, over 23 car washes also in our portfolio and various other assets as well. But those are just kind of vanity numbers. It's really the results. That is what everybody is here for. They want to replicate results. And that is, how do I get 100% choice and freedom on how I spend my time? Guys, I do these webinars because I love giving back to you. I want to show you not the quickest way between 2 points, between point A and point B. I want to show you how to collapse time, fold that paper in half so you can start building your own investment portfolio, even in this market today, doing that. That way, you can start taking in this hockey stick growth, right? Like, it's not going to be the first 1, 2, 3, maybe even 4 years of owning passive real estate. It's really when you get into years 4, 5, 6, and 7, you start seeing some of those exits and reposition. And now you're on that hockey stick trajectory. The first few years can be a lot like watching paint dry, but you got to start, and you got to start now. And we can actually help you do that here at passiveinvesting.com. For those of you who don't know us, we have over 1.4 billion assets currently under management. We have done, offered our limited partner investors, or this is our track record, 28.9% ARR on our full cycle on our deals. The average hold time has been 27 months and distributed over $51 million to our investors. Okay. So I'm about to get into the meat of the presentation. You guys hold on tight. For anybody that's here that says, is this being recorded? It is. It will be recorded. So watch out for that link to the recording in your email afterwards. But I want you following along with me and taking notes. Because again, this is where we move from just understanding into applying and analyzing. Okay. But nothing I offer here is going to be financial, tax, or legal advice. So make sure, as always, to consult your team before any investment. And if you haven't done so already, and if we haven't talked already, and you are interested in learning more about passive investing and what we do here at passiveinvesting.com, learning about our open deals, go ahead and scan the QR code or visit passiveinvestingwithwhitney.com. You can get on our email list, but you also, that is the only place that you can get access to my calendar, and we can talk all things passive real estate. All right. So really, when we talk about how to get into a passive deal, okay, we are executing initially 5 of 7 steps. Okay. The 5 of the steps come just to get you to the decision. Do I want to be in this particular passive deal that's in front of me? Okay, the other 2 are execution steps, like how do I read the legal paperwork? How do I wire my money? Okay, so there's really 7 steps in this process. Now, if you've been here for the previous episodes, you can go to our youtube.com page. It's youtube.com, passiveinvesting.com, dot is spelled out, D-O-T. You can see other boot camps where we've talked about the groundwork that has to be laid. You need to understand your investing goals. Are you in this for cash flow, equity, tax benefits, diversification? What are you in this for? What do you need from your investments? Then you also need to understand your risk and your timeline. All right. It's always interesting when I'm on a call with an investor and they're like, I want 0 risk, but I want 30% return on my money. I'm like, those 2 don't generally align with each other. So we have to make sure that we level set our risk with our goals. Okay, because that way now we can start looking at these deals holistically and figuring out what belongs in our portfolio. All right. Okay. But where we're going to pick up today is partway through the control piece. Okay. The groundwork is you. You got to understand what you need, what your risk, what your timeline is. Okay. The control piece is you now, based on your goals, your risk, your timeline, can now start screening operators. Okay, that was our last session. Screening markets, that was also in our last session too. But I'm going to teach you a 2-step process today for vetting a deal. Okay. We need to be able to get it to a quick kind of yes, I want more information. And then we need to be able to get a yes, I am going to wire money into this deal. All right. So recap here. When we talk about the groundwork piece, you have to know your goals. Do you like real estate as an investment? If you cannot answer that with a resounding yes, then private equity real estate is not for you. Okay. Now, again, in that you have to understand your goals. Like, what do you need from your investment? Here's some questions to maybe answer for yourself. Like, do you need capital preservation, cash flow, equity, tax benefits? Do you need to amplify your returns with good use of leverage? Do you need some sort of diversification in your portfolio? Are you too heavy in one asset class and need to add in another asset class? And then also ask that question about your timeline. Do you need your assets to go full cycle in 5 to 7 years, or 3 to 5 years, or 1 to 3 years? 1 to 3 year asset cycles are going to be extremely risky. Okay, 3 to 5 year, still pretty high risk, but I like the 5 to 7 year, hold periods, because it gives you enough time to work through generally any market cycle that you have happening in that economy. Okay, but those are all questions that you need to ask before investing. Okay, so know your goals. Now know the risk associated with investing. Okay, when we go, and this is what we're going to focus on primarily today, are those questions that are going to help us mitigate loss of capital, mitigate potential suspended distributions, and mitigate business plan risk. But all of this is, you have to ask these questions, understand this upfront, to make sure that you aren't taking an outsized risk to meet a goal that is not aligned with what you want. And what do I mean by that? Is, if you just cannot tolerate like any sort of bumps in the road with any sort of asset, but you are taking an outside risk in a development project, that is slated to be completed in 18 months, that's not alignment. Okay, so this is all about alignment with you. Okay, if you guys have any questions, I encourage you, please put your questions in the Q&A box. That helps me stay organized. Putting them in the chat box sometimes gets clouded with reactions. I don't want to miss your all's questions. So dump them over in the Q&A box. As I have time, I will answer questions in the order that it makes sense. And then we'll hang out for a few minutes afterwards. We might go over about 15 minutes, and I'll try to clean up as many questions as possible. All right, so this process is all about how to maintain control, right? And I told you, as a limited partner, what past you understanding what you need from your portfolio, when you go to investing, you have 3 areas of control: who you invest with, where you invest, and what you invest in. Now, I want to kind of level set what it means to have control. Okay, control doesn't mean eliminating all risk. It means determining the behavior of. Do you feel like you have a good enough insight into what is going on that you actually feel comfortable that you know pretty certain, like kind of end to end what's going on, what could happen, what could the result be, right? It's not about eliminating all risk, all right? So I just want to make sure that we are on the same page and share the same definition of control. The only thing I know that I can control is my reaction to an outside stimuli. I can't even control whether my dog who's laying asleep next to me is going to bark at the bunny rabbit on the other side of the window. I can influence it. I can try to supervise that interaction, but I cannot control it. Okay. All right. So again, if you guys haven't already gone through how to screen the operator, screen the market, I encourage you to go back and look at that previous podcast that we did, Bootcamp we did, because we're going to pick up here with how to screen the deal. Now, why do I start with screening the deal and not vetting the deal? Well, think of it this way. You get an email, you've talked to an operator, you've sorted out that they have none of the 8 red flags that we talked about in last month's webinar in their business. their investments align with what your goals are, with what your risk tolerance is, what your timeline is. They're in the asset class that you want to be in. You know, love and trust them. You feel really good about them. They're in the markets you want to be in. Okay, maybe like for us, they're in the Southeast and you love the Southeast. Okay, there was an article that came out in Axios today that just said the Southeast, 6 states in the Southeast make up more the national GDP now than the entire Northeast section of the United States. We're seeing a huge trend in that direction. We're very thankful to be in those markets. Okay, but let's say all of these things are aligning ahead of time and you get an email in your box that says, hey, this deal is open for investing and it's first come, first serve. Okay, now, what do you do with that email? Can you sit on that email for like, maybe you get it on a Monday. Can you sit on it the whole entire weekend until the weekend, 5 days later, and then evaluate the deal? Maybe not. Maybe the deal is just that good and it goes so fast. Okay. There can be a variety of things that happen that would cause that deal to fill up very quickly. All right. Even in today's market, we're still seeing deals fill pretty darn fast. Okay. Maybe not in 24 hours like we were seeing just 2 years ago. But, they don't hang around for very long. Good deals don't stay around for very long. So you need to have a really short process. That way, at the end of the day or sometime during the day, you can open that email and go run through a 5-minute screening process and be like, okay, I'm either going to delete this email out of my inbox or I'm going to put it in a soft reserve and buy myself some time so I can deep dive in vetting it when I have time in a couple of days. Okay. So this is a very important process. You have to have this in there. Okay. Now, most people's screening processes go a little something like this. Okay. This isn't actually a conversation that I had with an investor not too long ago. They called me and they were like, I'm trying to screen this deal to see if I want to go into it. I want to know what the profit on the deal is. Now, remind you, all this information is in the offering memorandum. So all these questions they could ask, but they wanted to hear me give the answers to them. I get that. But I want you guys to evaluate this. The questions were, what is the preferred return? What is the equity multiple upon exit in 5 years? When do the distributions start and are they monthly? What can I expect as a monthly return? And have you ever suspended distributions? Guys, take a minute. I want you to go to the chat box, go to the Q&A box. I want you to drop in the Q&A box. Is this a good vetting process? Okay. And does this actually answer the questions? Are these the things that you need to know in order to get to yes? Go to the Q&A box. Let me know. We got a quiet crowd this morning. I stumped everybody. No, just take a quick guess. That's why I have you put it in the Q&A box because only I see those answers. So let's see. Oh, somebody put in nope. Okay, good. What else? What are your impressions? No idea. That's fair. Okay, no idea, but maybe no. Okay, those questions are only about the business plan, not the operator, the market, or really even the deal. Okay, those are all great answers. I like this other question. Are the suspended distributions forfeited or caught up later? Okay, we need to dig deeper right here. So again, I agree with all you guys. Now, do I put this in as vetting a deal? No, I don't even put these list of questions in as a good deal screening. Now, they might be things I'm really interested in that I need to have in order for me to be able to say yes to a deal, but this really isn't a good deal screening process. I could still end up in a deal that I don't like that doesn't serve my needs, right? So what does a good deal pre-screening process look like? Well, so one, we want to make sure that deal matches your investing and personal goals. Okay, so if your goal is to create cash flow and there's zero cash flow with the deal, Okay. When does the cash flow start? How long do you have to wait? Or is there any cash flow at all? Does it have any equity? Does it have any tax benefits? Okay. You have to understand what it is your goals are, and does that deal have those goals, match those goals? Does it match your investment strategy and risk tolerance? Okay. If you're like, I will never ever invest in laundromats, and you get an amazing deal with laundromats that offers a 15% cash on cash. Okay. If you don't already have your goals lined out and your investment strategy and your risk tolerance outlined, you're going to be swayed by shiny object syndrome. Okay. So again, make sure that those, are matching. Okay. And hits your goals, hits your investment timeline. Okay. Is it from an operator you already vetted? If you get a deal from an operator that you have yet to vet, I ask you, please do not move forward with committing to the deal until you have gone through a full vetting process. Now, can you get that done fast? Yes, you can. You can get it done extremely quickly. Okay. But don't commit to a deal if you have not vetted with operator, or even if your friend just says your friend has maybe vetted the operator 2 or 3 years ago and they've been investing with them. Those are taking on a lot of risk. Okay, so I guard you to not do that, because your friend might not have the same vetting process that we have taught you how to create for yourself, a thorough vetting process. Okay. And then if you haven't talked to the operator, or you haven't vetted them very well, then you don't really have any idea on the 8 red flags that we always talk about, making sure that, you're investing with a team that doesn't have one of those 8 red flags in their business. Okay. So now that's kind of like, making sure that pre-screening. So only deals that are hitting your inbox should be from an operator that you have vetted. Okay. I want to say that again. The only deals that should be hitting your inbox should be from operators that you have vetted. Okay. Those are the only ones that you should be considering. Now, we all end up on lists. I get it. Okay. But create yourself a folder in Google or Microsoft Office, and you can create a rule, and it says vetted deals or vetted operators folder. And any time that you have fully vetted an operator and love and trust them, and it's something that somebody you would consider investing in, that have those emails go to that folder. That way, that's the only folder you're looking at. Everything else, allow it to go to a different folder, unvetted folder. Okay. And that'll help you kind of keep your inbox organized. All right. So how do we actually screen this deal when it hits our inbox? Okay. One, what are you looking for? Are you looking for a value add deal? Are you looking for multifamily? Are you looking for self-storage? Are you looking for express car washes? Okay. Know what you're looking for. That way, whenever that type of deal hits your inbox, you can go, oh, yeah, I'm looking for maybe multifamily, self-storage, and express car washes. Great. This deal hits one of those. All right. If it's a laundromat or something like that, I'm probably going to put that in the unvetted deal folder. Okay. Because it's not what I'm looking for right now. All right. Is it in the location that you want to be invested in? All right. Does it have the type of business plan? Now we're going to have a ton of questions I'm going to arm you with. Okay, guys. Does it have the type of business plan that you want to be invested in? And what do I mean by that? Is it a value add strategy? Is it a development strategy? Or is it kind of a core plus strategy, right? Understand what kind of business plan what are you looking for to put in your portfolio? And does that deal fit that overarching business plan? Does it have multiple pillars of wealth? And I'm going to dive deeper into that here in a second, but there's 7 wealth pillars, and I look for my deals to have as many of those wealth pillars in them as possible. Okay. Do you, at a high level, 30,000-foot view, like the loan structure? Okay. But this is an area that we're going to dive deeper in and ask a ton of questions. Okay. And then you want to just kind of, are they disclosing the capital stack? Are they disclosing the sensitivity returns? And are they disclosing the distribution schedule? Okay. And do those meet your kind of 30,000-foot view parameters? Now, this should all take place in 5 to 10 minutes. We're not that deep diving here yet. But again, this is just to get you to that quick yes for you to answer in your head. Do I want to set aside my time later tonight, tomorrow, or this weekend to analyze this deal further? Do I want to get on this list and not miss this deal? Or am I going to be like, okay, if this deal like kind of passes me by right now? Okay. All right. So for me, this is a pre-screening example. Okay. This isn't, I'm not giving you advice here. All right. But does the deal match your goals? Like for me, like I look for a lot of deals that have cash flow. Okay. I want a moderate risk business timeline. So I'm okay with 3 to 5 years. I'm actually okay if it goes to 7. Anything shorter than 3 years makes me a little way nervous. Anything longer than 7 makes me nervous as well. Okay, so those are my goals. Markets, I want to be in growth markets. I want to be in the markets where as many investing cards are stacked in my favor. Population's growing, income's growing, jobs are diversified, the whole 9 yards. All right, poverty's coming down, crime's coming down. I want to make sure that there's a high unit count here. So, and this is more of a pre-screening deal for multifamily. Okay, essentially what I want to see here is that there's scale. All right, there's some element of scale. There's more than like 2 or 3 units paying the bills on the property. All right, I look for B+ or Class A assets right now. For me, the cash flow is so compressed on value add B class assets that it's hard to get them the cash flow. And why take the risk right now? That's just kind of my thought process around it. Whole timeline 3 to 7 years. Sweet spot is about 5. A lot of people underwrite for 5. The returns. The returns are going to be class dependent. Okay. If you're investing in A class, B class, C class. Okay, they're also going to be market dependent too. Now, number 6 is really important for me. I want to make sure it has multiple wealth pillars. Now, by investing in real estate in general, I'm kind of locking in capital preservation right now. But that's not to say if I were looking at some other type of passive deal, like there have been investments in legal groups, debt collection agencies. Okay, those things don't necessarily have capital preservation to them at all. So that's one reason why I love real estate. It inherently has a lot of capital preservation elements to it. But also I want to make sure that it has a way of creating cash flow, multiple ways of creating equity growth, tax benefits, good use of leverage, and hedging inflation. For me, I look for distributions that are monthly or quarterly, and it has no red flags. Now, I can take this little teeny tiny screening list and I can whip through that deal email and go, it matches. I can match 7 of the 8 criteria here right now without having to deep dive. I'm going to block an hour out of my calendar later on to go through that deep dive into it. I don't know why I got out of there. All right, guys. Google has not been playing fair with me in the past couple of days, so sorry, guys, about that. All right. Get all my screens back up. Okay. Now, why have this screening process? Again, it's so we can move quickly to get to the next stage of the vetting process, but a screening process will save you time, headache, and heartache, right? Because there's nothing worse than having like 5 or 6 deals sitting in your inbox and you're just going, I have to set aside time to vet each one of these individually and run it through my very large underwriting checklist. No, we need to create a funnel and get 4 of those deals off the plate. That way you're only looking at maybe 1 or 2, okay? But you cannot rely on screening alone to say yes to a deal. You should go through a vetting process. So this is not where it stops. This is where, like I said, we're getting into our first yes to make sure to put our name on the list so we can get more information, get a look at the PPM, all that sort of stuff. But this is not the end of our vetting process. Now, as we move into the vetting process, guys, I'm going to move through this pretty quickly for 2 reasons. One, I'm going to tell you how to get a copy of the checklist if you don't already have it. But two, this is recorded. So you're going to be able to stop, pause, rewind as much as you need to really absorb these concepts. Okay. But for efforts of time, I'm going to move through some of these really quickly. Now, here's a list of terms. If you don't know these terms already, there are some videos on our YouTube page, passiveinvesting.com, again, dot spelled out. There's some short little 2-3 minute videos that help walk you through these different concepts. Okay. So, and this is also, if you look at the back of our offering memorandums, we do define some of these terms as well. All right. So again, your call to action, we're going to, take off here and dive really deep into the vetting process. But if you're ready to look at our deals, if you're ready to discuss your goals one-on-one and how we can help you meet those goals, you can join me at passiveinvesting.com or passiveinvestingwithwhitney.com. All right, guys, I was just keeping an eye on the time. So this is how I look at our deal vetting framework. Now, I know there are many people out there that share their vetting checklist, okay? They're great. I have one myself, very long, a lot of questions on there, okay? And you can always borrow a vetting checklist from other people and kind of like mesh them all together. Two things here. One, it needs to be your own, okay? Again, the checklist needs to align with the goals that you have. That's why I encourage you to work through this with me together. Two, really, at the end of the day, that vetting checklist is trying to answer 7 questions. The 7 questions are, how does this deal preserve capital? How does it create cash flow? How does it generate equity for me? How does it generate tax benefits for me? Okay. Is there good use of leverage on this property? Okay. Does it help guard against inflation for me? Does it help me hedge inflation? Okay. And you have to double check the operator too at this stage. Okay. That is what the checklist is trying to do. So when you organize your checklist, keep these 7 principles in mind. Okay. Making sure that you have questions in each one of these buckets and that you understand that the overarching thing is that your checklist is trying to make sure that you hit all 7 pillars of wealth. All right. So pillar number 1, capital preservation. What are we looking for? Okay. This is our buddy Warren Buffett. First rule of investing, don't lose money. Second rule of investing, see rule number 1, right? So we're looking for all of those things in the market that can help stack our investing cards in our favor. A piece of real estate cannot be moved, okay? Markets develop, expand, and contract over time, all right? So, but we want to know where that market is right now at the start of the business plan, and is it in the right part of its growth cycle, okay, in order for that business plan to really take off, right? Is the population growing? Jobs growing? Jobs are diversified? Is the poverty trending down? Crime trending down? What do the taxes look like locally? If you're investing in multifamily, like legally, what are some of the legal ramifications in investing in that asset class in that area? And then, comparable analysis, like, is that asset at the top dog in the market, at the bottom, or is it somewhere in the middle? Like, do you have leeway? Do you have case studies to tell you that the asset can actually exit at a higher valuation, right? Do you have room to grow there? Another way that you can look at preserving capital is what kind of operational reserves are on the property. I like investing with operators that carry a minimum of 6 to 12 months of operational and CapEx reserves. Now, most banks still only require 3 to 6 months, okay? But I like operators that carry somewhere between 6 to 12 months because now they have time to respond to the market. They have time, everybody can sleep well at night because nobody's worried about losing the asset. Should like the market turn sideways or south really fast, like we saw last year with interest rates just skyrocketing. Nobody knew how long that situation was going to continue to occur and if it was going to keep going up. And, rates for some operators rose so fast that they burned through an immense amount of reserves just trying to hold on to the asset. Okay. Another question to ask, and I can almost bet that you will not see this on most operators' lists, is that if they carry reserves, where are the reserves being kept? And can they invest the reserves? Okay. And if they do, where? Can they put them in a money market and make a few extra, dollars on them? Fantastic. Okay. They're liquid. Are they and another type of like liquidity, like vehicle that's backed by a hard asset? Okay, that might be great. But like if we heard, a lot of companies last year, like Michael Saylor, and I'm not equating anybody to like what he did or like, what Elon did with Tesla. They invested their company's reserves in Bitcoin and other, cryptocurrencies. Okay, we saw a lot of reserves get evaporated there. So are those reserves being invested and where are they being invested? The last point here is there a clear exit strategy and are there backup exit strategies, right? The exit strategy might be to sell in 5 years, but is there enough value being created in 5 years that they could do a refi if they, for whatever reason, couldn't sell? Is there other ways, for them to exit that property and reposition that property without having the primary business plan fully execute? And that's what we're seeing a lot right now in today's market. Some operators were hoping to do refinances right now. They can't for various reasons. So do they have a way of selling right now in today's market? Or are they having to go and get permanent debt financing on the asset and extend their whole time, like say from 5 years to 7 or 10 years, right? So make sure that the operator has thought through multiple exit strategies on that deal. All right. Number 2, cash flow. So somewhere in your due diligence checklist, you want to make sure that you're understanding how that pro forma, and it should be listed in the pro forma, how the income growth is being projected. Is it conservative income growth? Okay. How are expenses projected to grow? Okay, now expenses, the operator might be really hopeful they're going to be able to hold expenses down, but over time, expenses continue to annually grow at 2 or 3%. Okay, and then vacancy. How is that operator handling vacancy? This is where a lot of people got nabbed during COVID, right? We're underwriting at physical vacancy of say like 3 to 5%. But what we saw during COVID was almost double that. We saw there's physical and then there's economic vacancy, people unable to pay their bills. How are they underwriting the economic vacancy as well? And are they being conservative with their projections? Returns, the cash on cash, are they conservatively underwriting the cash on cash? Now, one way to kind of get at this, like I think everybody likes to say we conservatively underwrite our deal, is to actually ask for the underwriting spreadsheet. And if you're good with numbers, you're good at spreadsheets, you can kind of pick that apart. If not, you can bring it to somebody in your life that is really good at that. If not, sit down with the operator and have them walk you through, take like 10, 15 minutes to walk you through the numbers. If this is your first time investing, or if you just don't fully understand, I think, understanding the pro forma, how the cash flow is being created, how the equity growth is being projected is very an important thing. It's an important skill. And we'll take a look at a pro forma here in a few minutes. Break-even occupancy. This is really kind of important for multifamily and even like self-storage. Like how full does that property need to be in order to cover all the bills, including the debt? Okay, I love looking for properties that are like 50 to 65%. So their break-even occupancy is pretty low. You would have to go to historic vacancy that we've never seen before the asset is at risk of being lost. Okay. And then much like in our capital preservation piece, we want to see sales comps higher than the subject property with cash flow, we want to see rental comps higher than the subject property. Okay, so we want to know that we have a little bit of room to move with our business plan, that we aren't the ones that are like forging, we're not the guinea pigs on the rent growth, that we have case studies to tell us that market can sustain rent growth. And then also with cash flow, this is primarily your cash flow. What do you need? Monthly distributions, quarterly distributions. I prefer monthly personally, but quarterly, is definitely acceptable, I think, as well. So it just means you've got to be a little bit more, manage your finances personal finances a little bit better. All right, number 3, vetting. Okay, how do we vet the equity? Okay, so there's 3 different, and I'm going to start getting into some terms here. We're going to start kind of playing with these terms. But is there a business plan that clearly increases the net operating income on the property? Meaning, there's clear, the operator has clearly stated how they're going to increase the income, how they're going to decrease the expenses, and then maybe even how they can add additional streams of income or amenities to the property to improve value, right? Also with equity, we want to make sure that the operator has seen sales comps higher than the subject property that's being purchased. We want to make sure that there's a sensitivity analysis that's been conducted, okay? And I'm going to show you a sensitivity analysis, so we won't dive in deep at it here. I'll show you a waterfall, but we want to make sure that the equity stack, okay, all the different layers of money are something that you want to be a part of. And then the fees, okay, that plays into how much money you can make. Fees, these can include property management and asset management fees, but typical fee ranges, I do a webinar that dives deep into the fees. But high level here, typically we're looking at deals that have 1 to 3% acquisition fee, 1 to 2% asset management fee, maybe a 1 to 2% capital event fee. Maybe that's like a refinance or the sale of the property. That covers keeping all the legal transactions and the accounting and everything that needs to happen in order to get the transaction done. But there are other fees there. There could be a construction fee or a key partner fee or a guarantor fee, okay? But the biggest question here, are the fees performance aligned, okay? And 2, are they relevant to the project? So what do I mean by that? If you have a Class A property with 0 capital expenditures happening on it, you would not expect to see a construction fee. Okay. And unfortunately, I've seen that in deals. You're just like reading the documentation. They're like, there's no construction happening on this property, yet they're charging another 5 to 10% fee for construction. Like, why? So we want to make sure that those fees actually belong in the business plan of the deal. Okay. So let's take a little bit of a moment, since we've talked about cash flow, we've talked about equity. Let's talk about like all these different numbers really fast. Okay, again, I do webinars that dive deeper into these topics. I'm sure you guys are going to have questions along the way, so make sure to dump them in the Q&A box. But when we are looking at our financials, I'm trying to figure out the difference between what are the actual returns on the deal and then what is a performance hurdle. Okay, because I find a lot of times investors confuse the performance hurdles as returns. Okay, so an actual return on the deal, you're going to be looking at cash on cash. You're going to be looking at the numbers that are labeled internal rate of return, numbers that are labeled annualized rate of return, and then equity multiple. Okay, that's what you as a limited partner can orient around, like what money ends up in my pocket. Now, a lot of times when I'm talking to investors, they're like, no, I want to be in a deal that offers like an 8% preferred return. I'm sorry, I can't do this deal or whatever. The 8% preferred return is not really a return at all. It's a performance hurdle. So what it means is, in our case, in our multifamily deals and self-storage deals, the first 7% of the deal goes to the limited partner investor. And at that hurdle, we now start splitting money. Okay. We start splitting a certain percentage to the limited partner, certain percentage to the GP. Same thing in our car wash deals. Our preferred return is higher. It is at 10% preferred return. It doesn't mean year one that the asset's going to kick off 10%. Okay. It just means that until 10% preferred return is met, the limited partner gets all that 10% before we start splitting between the limited partner and the general partner. So it's a hurdle. Okay. And then other hurdles you can have are what we call internal rate of return hurdles. So on the sale of the asset, maybe the preferred return gets met, all the capital gets distributed back to the limited partner. And then whatever's left over, the limited partner is made up to say like 13 or 15% internal rate of return. And now you have another split and the general partner gets to start sharing in the profits of the asset. But again, those are all performance aligned. Okay, you want to make sure that you understand how to read those. Now, here's what cash on cash actually means. It's the annual dollar income return divided by the total equity invested. That's your cash on cash. Okay. And I'm going to show you an example of this. So guys, don't get mad at me for going fast. Internal rate of return. Internal rate of return is a nice calculus equation. Okay. So, but it's the rate of return that would make the present value of the future cash flows plus the final market value of an investment opportunity equal to the current market price of the investment opportunity. Long story short, the higher a project's internal rate of return, the more desirable of a project it might be to undertake. Okay. All right. So how I put this is that it takes into account time, right? Where the other equations do not take into account time. So here our N equals time, our holding period. Annualized rate of return doesn't really take into account time. Okay, so it's the average return per year during the investment hold. Okay, it does not include the return of the capital of the investment. And then our equity multiple, okay, equity multiple means total cash distributions received from an investment divided by the total equity invested. So it's essentially how much money an investor could make on their initial investment. So if you invested $100,000 and at the end of the asset, when the asset sells between cash flow and the sale of the property, you make over that 5-year period, you make another $100,000 on top of it. Your equity multiple is 2x, right? Because you have doubled your money. You get your initial $100,000 back, and now you made another $100,000 on top of it. Okay. All right, preferred return. Here's another definition. PREP describes the claim on profits given to the preferred investors in a project. Okay. So again, we talked about this being a hurdle, not necessarily a return. Okay. So how does this start kind of playing out when you're looking at a deal, performing due diligence, right? You're vetting a deal. So in this particular deal, this is one of our deals, okay, kind of typical of a multifamily deal. We've got our typical, this is what a capital stack looks like. So we've got our initial debt layer, and then we have the percent ownership of the equity on top of that. Okay, 70% ownership to the limited partner, 30% to the general partner. But this doesn't tell you anything about who gets paid what and when. It tells you nothing. It's just the capital stack. So over here is the partnership structure. This starts telling you a little bit more insight about who gets paid what and when, but it doesn't give you the full waterfall story. But here, on the cash flow, 7% preferred return goes to the investor. Remember, that's our hurdle. And then after that 7% preferred return is met, then the limited partner and the GP starts splitting 70% to the limited partner, 30% to the GP. And the membership ownership, that's whenever that LLC or the asset sells and the LLC dissolves, right? We're dissolving the membership of the LLC. We've got 70% goes to the limited partner until the next hurdle is met, until a 13% internal rate of return. And then afterwards, people split 50-50. Okay, the LPGP, right? Okay. But again, I kind of ran through this a little bit, described what was going on here. But there can be other things in here that can be sneaky that operators throw in here, like things like a general partner catch up. Okay. Now, I'm not going to dive into that here, but you need to understand if that's in here. We don't do general partner catch ups, GP catch ups at all. But if a GP catch up was being slid in here, it's going to be slid in like right somewhere around here, like right after the capital. So essentially, 7% preferred return, we go back to the limited partner. And then before the limited partner or any other capital got distributed, then the GP would be able to go back and reclaim their 30%. Okay, that would be an example of a GP catch up. Again, that doesn't align the limited partner and the general partner very well. Okay, so if you have more questions about that, feel free to reach out. We can dive into it deeper. All right. Now, again, these are all the things that you're trying to suss out in the offering memorandum. Okay. If you don't see a capital stack, or if you don't see the waterfall structure in there, or if you don't see what I'm about to show you next, the sensitivity analysis, you need to ask the operator for these things. Okay. Now, a sensitivity analysis is just a method that takes into account several factors that might impact the investment and the investment returns, and essentially help you calculate the profit during the hold. Now, the thing is, it's important for you to understand the sensitivity analysis and get a visual at it. One, you want to make sure the operator doesn't have rose-colored glasses on, that they're only looking at the market going up. They're not looking at what's going to happen to the return numbers if the market goes sideways or south. But two, you want to make sure that they're not manipulating the internal rate of return and the equity multiple, because they can be, right? And how can you figure out if they're manipulating things? Well, one, if they're putting in rent increases like 10% year over year over year, that's going to manipulate the return, right? Are they being conservative with the rent increases? Are they being conservative with their vacancy? Do they have a conservative business plan in a timeline, right? Do they have a lease-up strategy in place? If they're doing construction, are they eyeing a 9-month construction window for 200 units? Or are they giving themselves closer to 2 years to get it done? And if they hit it in 12 to 18 months, fantastic, right? Are they being conservative with their numbers and their growth? And then have they stress tested everything? And that's where the sensitivity analysis comes in. But that analysis is only as good at the numbers that you put in there for rent and expenses. Why? Because it's predicated on the net operating income. So if you're making wild projections with your rent increases or how low your expenses are going to be held to, how low you can hold them down, of course, that's going to raise the net operating income and inflate these numbers. So again, take a look at that business plan, get comfortable learning how to read those. But when you're looking for a sensitivity analysis, you're looking for a grid like this, okay? Has that operator taken a look at what happens in the market should the cap rate expand, meaning the market's getting worse, okay? And what happens, on the various returns on distribution or returns based on disposition, right? Like, do they understand what's happening with the IRR, the equity multiple, the average cash and cash, and the annualized return? Okay, do they have a grid like this? Okay. Now, on this particular grid, this cap rate on this property was 4.2%. So we're giving our investors, we're showing the projections of that cap rate expanding pretty rapidly within 5 years. Okay, so if they're comfortable with all these returns they could make if the cap rate expanded, it might be a good asset for them to invest in. All right, so we made it through 3 pillars. The last 4, I can kind of go through pretty quickly. I know we're almost at time. I will go about 15 minutes over so we can leave a couple minutes for questions. But the next one here is in the deal vetting piece is tax benefits. So we want to, when you're going through your vetting process and that hour that you sit down with a deal, you want to look at how are they taking advantage of depreciation? And more importantly, you're probably looking for the word cost segregation analysis. How are they going to perform a cost segregation analysis on that asset? Are they going to take advantage of accelerated depreciation, bonus depreciation? And are they going to move that forward to the first few years of the project? Okay, so that's one. Two, you also want to know how they're sharing that depreciation with you. And this was really eye-opening to me a few years ago, because as I was starting to add more and more operators to my portfolio, not everybody shared tax benefits for their limited partner investors. And it just never occurred to me that that would happen. But you want to make sure that the operator is sharing at least pro rata tax benefits with the limited partner investor. So meaning the percentage ownership you have in the LLC or the entity, you want to make sure you're getting at least that percentage of tax benefit passing through to you. And then, this goes back to your goals. Do you need it to be a 1031 exchange? Meaning, if you invest in that passive asset, when it goes to sell, do you need the operator to be able and willing to execute a 1031 exchange? Okay. Meaning that you're going to continue to defer your gains and your depreciation recapture to future years. Or are you okay investing in a deal that the operator has zero intention in performing a 1031 exchange? And that means just you're going to consume all of the gains on the sale of that asset and then go look for another deal moving forward. All right. Deal leverage. Okay. We're looking for smart use of leverage here. So we've got the, what type of lender is the operator using? Is it public or private? Public lenders like your government sponsored entities, Fannie Mae, Freddie Mac, those probably are going to have prepayment penalties or yield maintenance associated with them, and they're going to have lockout periods. All right. So know that. If it's a private lender, maybe not. Okay. But more importantly, you want to understand the loan. Okay. Now, loan to value is probably crept down somewhere between 60 to 70%. Okay. But I definitely, for me, I want to keep it under 70% or less. And if I can, I want the loan to be a non-recourse loan, meaning should something go sideways or south with the deal, that the operator and the investors in the deal aren't held liable at all for the deal. Okay. As long as there's not fraud. Sorry, I have to put in the disclaimer there. Fixed rate debt versus, floating rate with an interest rate cap. Fixed rate deals, you're probably going to find more on your public type of loans. And if you get a fixed rate deal, you're more likely to have a prepayment penalty or yield maintenance on it. Okay, but I can, make everybody feel warm and fuzzy at night. If it is floating rate, it has the deal been fully written at the rate cap, and has a rate cap been purchased, and are they escrowing for the next rate cap? Sorry, guys, this thing keeps kicking me out here, but we'll go right back in. Anyways, so you're going to be looking for those things. You want the debt to be for at least as long as the business plan is. So if you have a 5-year business plan and the debt's only 3 years, does the operator already have extensions negotiated in place to get the debt to 5 years? Okay, so we want the debt to at least be in place for as long as the business plan, because the last thing we want to have to do is be forced to refinance in the middle of a poor market just because of the debt, the debt structure on the deal. Okay, and then we talked about it earlier, break-even occupancy. When we're looking at break-even occupancy, we looked at it as a way to protect cash flow on the deal and to protect the equity on the deal. But we're also, when we look at that break-even occupancy line, we're looking at it as a way to ensure that the debt expenses aren't going to get too out of hand for us on that deal. All right. We talked a little bit about a waterfall and a capital stack. We talked a little bit about the differences. I'll run through just an illusion, visuals here. The capital stack is what kind of debt and layers of money are there in the deal, okay? And who is in a low risk, higher priority to get paid back. Okay, so in this case, senior debt usually takes the lowest risk position, highest priority to get paid back. And then the common equity is generally in the highest risk position and the lowest priority to get paid back in the deal. But why it's important for you to understand there's a difference between capital stack and the waterfall is because you're going to probably look two different places to find it. The capital stack almost certainly is going to be outlined in the offering memorandum, but the waterfall may or may not be outlined in the offering memorandum. You might have to go to the PPM, the legal documents, to find that, to do that vetting piece. And so the biggest thing that I can put here is the reason why you want to understand this is that oftentimes limited partners confuse themselves. They think they're in a debt position on the deal, okay, when really they're in an equity position. So they sit behind the debt in the deal. And so the LP sits behind the debt in a profit sharing position. They share in the distributable cash flow after all expenses, fees, debts, and reserves. They are not in the LP distribution is not an expense line on the profit and loss statement. So how I put this to people to make it really easy for them to wrap their head around is as a limited partner and a general partner, we're partners. We're going to make money together, right? And we're going to share in the expenses together, okay? When the times get tough, we are going to share that burden together as well, okay? But the general partner is taking a fiduciary responsibility to manage that asset to get it through any of those rough patches, okay? So again, we've already did a good job at outlining this before, but this is what the capital stack looks like here on the left. For us, we put in the partnership structure that's going to give you an insight into the waterfall. Other operators do it differently, okay? Now, deal flooding, we're on pillar number 6. We only have one more to go after this. But, inflation hedging, you're looking for ways for the operator to lock in the debt today and pay it back with future devalued money. And that's one traditional way of looking at inflation hedging. But another cool thing about inflation hedging when it comes to real estate deals is that we're especially buy and hold deals, income producing property and businesses, is that we have the ability to raise the income regularly as well as just the expenses regularly in response to economic and market environments. And so as inflation occurs, we actually can raise the rents because there's more dollars chasing the same amount of goods. So we can raise the rents on these properties. Okay. Now, rule number 7, we're talking about the operator. Okay. If you were here for last month's webinar, we went pretty extensively into that. You can find that on our YouTube page. But I even put it back in here as part of your deal vetting process, because you may have done multiple deals with an operator, but you just want to or maybe it's your first deal, but just, make sure that you are doing a couple of these things pretty regularly, just to make sure that nothing is materially changed with the operator. One, that if you're initially investing with an operator, that there's none of those 8 red flags there, okay? 2, you're talking to the referrals, okay? That way you're getting, you want to talk to investors in current deals that are operating right now. That way you get a current snapshot of what's happening with the business. And not people that have been exited out of deal 5 years earlier. You want current referrals. Also take 2 minutes, seriously, 2 minutes. Go to the Edgar database, Securities and Exchange .gov, SEC.gov, and Scooter Echo Charlie. Sorry, I don't know what they say for S. Sorry. But there's an Edgar database there. And that's the filings for all the previous deals that operator's done. Look them up. Make sure they've done their paperwork. Okay. Databases aren't fun to necessarily manage and navigate. So there's a streamlined version at formsd.com. Go there and make sure that the operator is keeping it current on all of their paperwork. Okay. And then this is something I like doing. Go to Google and just put in your operator's name and then type in the word legal or lawsuit after there. Okay, just do a quick little Google search and see what pulls up. Okay, maybe each one of the partners' names, the business name. Make sure. I mean, you might see traffic tickets or something like that, but what you're looking for is something more substantial. Okay, but that's a quick, little easy way, and do that even if it's somebody that you've invested with multiple times, do a regular check. I mean, and just, you don't want to be caught. This is your hard-earned money. You don't want to be caught with any surprises. All right, guys, we've covered a lot of ground today. I want to make sure I leave a few minutes open, for Q&As. I know we've got a couple in there, but here are your action steps. Okay. Make sure define your goals, your risk tolerance, your timeline, everything aligns. Okay. Make sure you've gone through the operator vetting process. Double check your markets, and then set up your deal vetting process. Now, guys, I have a tool for you. Okay. You can email me, and I'm going to give you my email, and you're going to say LP tool spreadsheet. That's all you need to say. And I will email you back. If you already have it, you have it. Like if you were at last month's workshop and you asked for me there, you already have my underwriting tools. But this just gives you a little starting point to start creating your own. You're going to go and download and make a copy of yourself and manipulate this to what would work for you. But you can email me at whitney@passiveinvesting.com to get access to that. And then once you go through your vetting process, make a decision. Okay. Most people fail in their investing because they fail to get to a yes or a no in a timely fashion. So that's why I say, when you get to through that initial deal vetting screening or that deal screening process, and you have made a pact with yourself, you're going to check this deal further, put an appointment on the calendar that you're going to vet the deal and make a decision. Okay. Put it on your calendar. Don't let that deal continue to take up mind space. Okay. And then number 7, then we're getting into all the different fun ways that you can fund your deal. We'll cover those in future episodes. All right. Again, you can reach out to me at passiveinvestingwithwhitney.com. If you want access to that spreadsheet, feel free to email me at whitney@passiveinvesting.com. Guys, I know we went a few minutes over, but I added in a few slides to make sure that we covered some topics that we haven't covered in quite a while. Go over to your Q&A box and drop in your question, and let's get the party started.